See, whenever the word accounting policies come, it actually shows what are like the framework or the standard practices. I'm using the word standard practices that particular company or a firm, that might be a business, small business firm also, is operating and using to report its earning. So any shift in its earnings report and the approach which is used by it, or the standard practices which we say, might be leading to a change in accounting policies. The best examples which I can give you are like yesterday we studied LIFO, FIFO methods. Since you guys have attended yesterday's class, can you please tell me in which, like, US cap or IFRS, in which accounting framework that LIFO is banned to be used? I discussed this yesterday.
Yeah,
Sorry?
US cap.
No, it is IFRS. Think LIFO is banned in European countries. The best way to think is this. So in Europe, it follows IFRS.
So you said LIFO is banned.
Yeah.
Okay, okay, okay. So sorry. Okay.
Okay. No worries. Although you got the logic behind this, so
Yes, yes,
like
yes.
the discussion for me, let's assume now you are in US GAAP following company, so you are in USA. Now there is a shift in your accounting policy for inventories from LIFO to FIFO. So this is something that you have changed in your standard practices in order to report your earnings in such a manner which was done earlier. Now you have changed its approach altogether. So it will directly or indirectly have a effect on your earnings report. Although the stock in your like warehouse won't change, but like the way it's presented now, it will definitely will have a effect. Like because like changing from LIFO to FIFO will have a effect in both like the closing stock as well as the cost of goods sold. So that way our income statement due to cost of goods sold and our balance sheet due to closing stock, both of them would be affected in terms of value amount. Now the next best example I can give you is that since there might be some set of property plant of equipments that we had purchased, that initially we were having opinion should be capitalized, but now since we think that there is no future economic benefit derived from this, so we might be even expensing it instead of getting it capitalized. Now our like auditors, since I told you like there is a auditors meeting or audit committee meeting in India, it is said as audit committee meeting prior to release of any company's quarterly report, like 10K of India, which we can say, or sorry, 10Q of India, which we can say, or even the annual report that is 10K in India, which we can say. So before the release of all of these, there is a audit committee meeting. Whenever the auditors like usually question the approach of the any expense line of item which is marked in any company, so they might even raise this question, and if it satisfies the management also, they might be even required to change their financials due to this. So it can be either ways, like they might be changing it from capitalization to expense or expense to capitalization if they think like the expense they have incurred should be having their effect for a number of years, not for a single year that they are operating in, that they would be able to derive its usage for a multiple course of years that they can have it. So they might be changing their approach, let's say from expense to capitalization, or if they are in capitalization, then the reverse course, like from capitalization to expense. So both of these things are the best examples you can have for change in accounting policies. Now there is a change in accounting estimate, their next word is mentioned. So can you tell me like how in a like a layman language we can say there is a change in accounting estimate? The word is estimate. Best example can you give me of change in accounting estimate? You might have even studied in 11th 12th also if you are having commerce.
Sir, what if our projected figures are not matching with what we had predicted in the past?
Correct. Forecasting or like the project report, if you are saying that way.
Yes.
Y- Yes. Forecast to actuals, F2A, which I say. Yes, it is a cost of accounting estimate analysis, but like what could you derive any conclusion out of it? Like how we had done the change in accounting estimate. This is a variation that you pointed out to me, like our actuals are way like deviated from the what I would say flash or what I would say forecast over here. So like this variation, how that would be accounted in this accounting estimates. One thing to add over here, this accounting estimate is the major source for cookbook activities for any like fraudulent activity to take place around the world. Like even Satyam started, although it didn't do this, but it was his ultimate intention to do the cookbooking for ultimate investors. Like they were like showing a huge chunk of their profits. So again, this accounting estimates actually are at the discretion of management. So management have a upper hand in deciding what to do, what not to do. So it's somewhat internal to a company, I can say. And yesterday I showed you an example of depreciation. There were two methods. One was SLM, one was WDV. Okay. In this SLM and WDV, if you can recall, I asked you one question, like they were having a life, useful life. The word was useful life of 5 years. And I asked you a question like in year six, what would be the depreciation? And you told me the depreciation would be zero. Reason being the asset life is only 5 years and it won't be even surviving the very next year. So how should we depreciating in that sixth year only? So going on that line only, that example which I gave you, it how like first of all how that we are able to derive our expectation that useful life उसकी 5 साल ही होगी. It can be 6 years, it can be 10 years, it can be even 3 years also. Like how we are deriving our estimate, it is again the management who is doing like all of these discretionary activities first of all. But yes, management को करने से पहले एक valuation या valuer की report भी लेनी पड़ती है, या like that machinery expert की report लेनी पड़ती है in order to have a saying that this report, as per this report I am concluding that this asset is lasting for 10 years, 6 years, 5 years, 4 years. But since, guys, this is somewhat an internal activity, management might be using its favorable valuers or might be paying some amount to them in order to tweak that report in its favor. Like if they want to report uh, a very high depreciation, then what they will be doing in order to increase the depreciation, in order to lower their profits, what they will be doing, they would be decreasing that useful life of the asset. What effect it would be giving, उसका हर साल का जो depreciation होगा, the each and every year depreciation would be too high. So too high depreciation, because let's say if it is 100 divided by 5 years, it was actually coming as 220. Like now 100 divided by 3 years, now it's coming somewhere 33.33. So since the depreciation per year depreciation has increased from 20 to 33.33, so this increase in depreciation by changing the life of that asset will definitely affect the net income. From net income, that PE ratio, EPS, all of these stuffs would be affected, undervalued, overvalued pictures showing to the ultimate investors. And this is how the cookbooking activities takes place. So this is the best example I can give you of change in accounting estimate, but there can be n number of examples. And whenever any question comes in the exam now, you should be thinking like the best way to solve that question, like whether it is accounting estimate or not, think kya management, whether management can change all of these things or not. If management has a upper hand in changing all of these stuff, it's a management discretionary activity. So yes, it's somewhat a change in accounting estimate. Now there is something by the name of prior period adjustment, the third terminology. Can anyone tell me like what is prior period adjustment? We are having a good discussion, guys. Like, let's continue the rhythm. Like, what is the prior period adjustment? Vansh, Neha, Janvi, even Gaurav, would you like to have a try?
So something which is related to a cost which hasn't been written down in our books
Hmm.
in the prior period, and then like it has come up now, and we are making that cost in our books so that we can match it.
Hmm.
I mean, I have that uh,
See, you have
in
hit it
there,
the
but
bullseye. You have hit it the bullseye. Actually, your way of telling the answer is absolutely right. Like we had done some error in the past, which we needs to be corrected. And yes, how to do? Like first of all, begin with something which is done in the past. So prior period adjustment we are doing retrospective basis, and then we are modifying our financial statements with this like approach. So the word is restated whenever any prior period adjustment is done. So multiple companies uh, used to report restated earnings also as and when they come across some accounting error, or what I would say a genuine mistake on their part. So it's need not to be accounting error or fraud to make it a private adjustment. It can even be a genuine mistake. So even if in India NFRA was saying something at the time of year like 2017, because 2016 it came for the first time, the Indians came to India. So NFRA was not in even in picture at that time. Even ICA, the Institute of Chartered Accountants of India, was saying let's report some revenue in this basis in the financial statements for the Indian company. But when NFRA came in picture, NFRA told like 2 years back that this is not the correct way of reporting any accounting adjustment. So you should be tweaking your prior period like financial statements and reporting the true picture for that closing opening balance in this year also. So this way we are restating our earnings starting from the past years to till this year. Maybe due to some financial regulations also, maybe a genuine mistake on our part also, or might be due to some accounting error also. So it need not be a fraud, but it can be a genuine mistake also. So this is how the prior period adjustment is done. Now I'm just reading it like such changes may either require retrospective or prospective. It can be a case for all three of them. A change in accounting principle is reported in the income statement net of taxes after extraordinary item and before net income. This is like there is no logic for me to give it over here, but the best possible like judgment I can give you like on this line is that whenever there is a change in accounting principle, guys, we need to report it net of taxes after extraordinary item but before net income. It means to say कि हमारी जो net income है पैट वगैरह उसका उस तक आपको इसका इफेक्ट लेके नहीं जाना, बट उसे जस्ट पहले एक लाइन आइटम में आप अपने एक्स्ट्राऑर्डिनरी आइटम्स दिखा सकते हो इन द इनकम स्टेटमेंट इट इज सेइंग. So the question might come to you in the exam like net income में ये चीज आती है नहीं आती, first of all whether it is a part of net income or not, and if yes, then tell me like what is the right answer, and if no, then what is the right answer. So no we would be saying, and reason being because it somewhere comes before net income, and it is termed as extraordinary items, just a one line of item above this. So there is no example for me in handy to give you, because like I yesterday searched multiple companies also downloaded their report, but it usually it's not a usual course of affair. Like we will be seeing this extraordinary line of items in any companies like balance sheet or the income statement if we are just finding out. But yeah, like a multiple companies we need to drill down on for multiple number of years also, like the time series analysis I need to do. Then only like out of 20 there might be a one company, single company, or in a even in a single year, like it might have done in the year of 2018. I can recall Dell reported it extraordinary earnings. So that way you need to search it, but it's not you see in a usual line of business for different companies, so there is no example in handy for me to give you. Now, there is change in accounting policies. Sometimes a firm may change which accounting policies it applies. For example, by changing its inventory costing method, like from LIFO to FIFO, or capitalizing rather than expensing specific purchases. Or it can be either ways, like expensing to capitalizing or capitalizing to expensing also. Unless it is impracticable, changes in accounting policies require retrospective application, and it makes sense also. Like you have to make good like what the wrong you have done in the past, so it's somewhat like the retrospectively you have to correct your mistake. Now in the change to revenue recognition standards, firms were given the option of modified, the word is modified retrospective application. So it's somewhat means to say there is substance over form, which we used to say in a accounting word. But the moral conclusion which I can say कि like Hindi we need to say कि उसका ultimate effect आ जाना चाहिए without even doing that thing. uh, whereby I mean to say this, like our ultimate effect should be that कि हमारा our opening balance should be modified. Instead कि all the years respective balance sheet should be modified. What we do, we only modify the opening balance of this year only. This is how the modified approach works. So I'm reading is, this application does not require restatement of prior period statements. However, beginning values of affected accounts are adjusted for the cumulative effects of change. Let's say since we shifted from LIFO to FIFO, our inventories, first of all, the closing inventory, which is standing in our balance sheet, it got affected. So what we will do, the inventory balances, instead of making a separate balance sheet due to this what I would say change in policy, it doesn't make sense कि आप अपनी पूरी की पूरी different years की you should be preparing once again all of your balance sheet. But the best approach, like which you can do, and it makes logical sense also, कि just prepare a balance sheet part which is relating to inventory and for respective years, and change the opening closing balances for that year. Let's say you got a change in the year, I'm saying starting from 2016. So 2016, we are in 2024. Although I'm giving a huge years gap, it never happens. It actually happens for 2, 3 years only, guys. But whenever let's say we are standing at 2016, instead of modifying all the years, let's say 17, 18, 19, 20, and so on and so forth till 24, what we will be doing, we will be changing the opening and closing balance of inventory in a notes to accounts for respective years, and like the closing balance of 2016 would be a opening balance for 2017, guys. So that way till 2024 we will be deriving our opening balance for 2024, and on that basis we can say that yes, we had done a retrospective application, but it is not a complete approach, it is a modified approach. But yes, the ultimate effect or approach that we want to achieve, it is now yes achieved. So that way the modified retrospective application works. Now there is something by the name of change in accounting estimate. Generally, a change in accounting estimate is the result of change in management judgment. I told you it's at the discretion of management. The word is discretion. Usually due to new information. For example, a management may change the estimated useful life of an asset because new information indicates that the asset has a longer or shorter life than originally expected. That is the useful life in depreciation calculation. Sorry, there is a changes in accounting estimate are applied prospectively, not retrospectively, mark this word, and do not require the restatement of prior period financial statements. And it makes sense because now you are changing your estimate. Now, like initially you marked it like 5 years for the useful life of the asset, and now you are changing it to 3 years. So you shouldn't be making the effect of like depreciation for which you have reported the earlier depreciation figure. Since with the coming of new technology, let's say you are standing in 2024, till 2022, you this was your year of purchase of the asset, purchase year. Now 2023 also passed. Let's say there is some new technology derived in the year in which you are standing 2024. With this coming of the technology, you are able to determine that instead of 5 years, the new life should be 3 years only, because like this is the final year of application. So how will you proceed with this? Like in 2 साल में जितना depreciation ले लिया so ले लिया, like how much depreciation is already accounting is accounted. But now since it is the last year of operation for your asset, so the remaining asset value, which I give you example in WDV yesterday also, all the remaining value would be a part of 2024's depreciation, and that's it. This is how you will be changing the first of all the useful life, then changing the depreciation amount to be adjusted in your financials, and this again would directly have an effect in your net income. So with the coming of technology, this is the best reason I can give you that it is somewhat makes sense to apply it prospectively rather than retrospectively, and we are not even restating, because restating doesn't make sense because that has committed in the past, and we were not even aware that उस time हमारे पास 5 की जगह 3 साल हो सकती थी life. So this is how all those things works, and now the analysis implications, the accounting estimate change typically do not affect cash flows, because depreciation, again, you can think, or even useful life or any other management discretionary item. Forget about depreciation. Any other item, let's say, uh, our company is in the business of hydropower. So hydropower, usually they construct a dam on a river. They channelize the energy which the flow of the river is actually having in it, and then like after generating the electricity out of it, they again give that water back to the river only. So this is this hydropower. Let's say we made in, let's say our company made in Nepal, or even in Himachal Pradesh in India also. Any company, let's say. Um, I'm not even like remembering any name of any top companies, but let's say VSLP or all of these companies which are actually not deep diving into hydro activities. So they might have opened one dam over which they are utilizing the hydro energy contained in the water. So they might have used that plant initially with the estimation that its useful life must be for, let's say, 40 years. Now with the coming of new technology, they came to find out that there are certain breaks in that dam. With the coming of breaks, they are like of the idea that it might even not even last for 10 years also, and we need to make a capitalized expenditure on repair. So there are two things, guys. First of all, the repair that would be done is something not a expense but a capitalization. And then the starting of point of discussion was that instead of 40 years, the dam life is now decreased to 10 years for that hydro company. So this decrease in the life of that dam would be termed as something a change in management discretion, because they are now backing it on the report, let's say of some what I would say construction company, let's say. Larsen and Toubro might have sent one report on the construction quality. So Larsen Toubro's report might be used as a basis for changing the useful life from 40 years to 10 years for the dam. So this is how the management discussion usually works, and it makes sense because initially when they made it the dam, it was actually a long-term tenure instead of a short-term tenure, and now we are actually making an adjustment as of today for what we are seeing for the future. So it is known as applied prospectively and not retrospectively. Okay. Now there are prior period adjustments. Sometimes a change from incorrect accounting method to one that is acceptable under GAAP or IFRS is required. This we had just discussed in the like 2 slides back. A correction of an accounting error made in previous financial statements is reported as a prior period adjustments. We even say it as PPA in like what I would say financial reporting word. This is actually said by the name of prior period adjustment is said as PPA. Even some companies' financials, like the income statement, balance sheet, or even the notes to account, uses the word prior period as adjustment and not like the full from that. Sorry, they use PPA and not the full from prior period adjustments, and they require retrospective application. The retrospective application actually makes sense. Reason being, the error was something committed in the past and not the present, and it makes a reasonable business sense to make it a retrospective application. I just want to know one thing, guys. Me as a student, I used to confuse in two terminology. Like one was PPE, one was PPA. Like, can you tell me what is PPE? This you might have came across this word like PPE. It is yes
Prior
once.
period estimate,
Sorry.
prior period estimate.
No, no, no. It is property, plant, and equipments. Actually, some companies it usually happens in US that somewhere they uses this word PPE, somewhere they use this word PPA. So me as a student, I got usually got confused like what is PPA, what is PPE. So PPE actually stands for property, plant, and sorry, not estimate, it's equipment. I wrongly written this. It's property, plant, and equipment. It is said as, and this PPA stands for prior period adjustments. So these are some of the terminologies like which we came across in usual different companies consolidated balance sheet as well as the income statement for especially for US companies. Even in India, this PP word is used. PPA is not a usual practice for India, but in Indian accounting standard, that is Ind AS, this PPE word is used. Okay, that is property, plant, and equipments. Now the prior period results are restated. I told you like there should be a change, and it is a retrospective, so it makes sense for restating. Restating means आपका पूरा बैलेंस शीट दोबारा से बनेगा in terms of changing with the change in this accounting error. So it is actually a Herculean task to restate your earnings. So you might be coming across this word for certain financial reports for different country companies. I think it was in 2014 that Gap Inc. restated its earning, but I need to double check. But yes, you can see in any company for you can do a time series analysis like पिछले 15-20 साल की report you came on like googling, and then you might come across a report that might be saying as a like a star note they have mentioned in the start, and in a footnote they might have mentioned that these are the restated earnings and not the actual earnings. So this is how the what I would say reporting financial reporting works on a usual practice. Now the disclosure of any significant prior period adjustments and its effect on net income is also required. The word is disclosure. Since I mentioned you, they usually disclose it in a footnote that these are restated. So restated means again our earnings as well as our balance sheet value might be affected. So due to this change, there might be a change in net income. This change in net income will ultimately affect EPS and then our PE ratio. So there might be a regulatory requirement to have this disclosure, guys, because how will you be having a trust on your like what I would say the ultimate investors if you're not even true fair reporting. So for the like maintaining the trust on your own financial statements, it is required that please first of all restate and then please mention that what is the after effects. The word is after effect in your like footnotes. Like our net income is in earlier year it was this much. Now this year it is this much. So this is how the restated earnings are done. I think I have one. Um, this is let me search it once again. No, they have just provided like what they will do in terms of restatement. I No, there is no restatement in this. But yes, you can like Google it if you like come across any report like when restatement happens, they usually write like let's say for 2023, our net income was this prior to restatement. Let's say it is 10K, not 10K. It would be confused with the 10K form. Let's assume it is $18,000. Now, post doing this prior period adjustment in the year 2024, again we are presenting the reports for 2023 restated. So now our net income versus $18,000, now our net income standing somewhere at $14,000. So this is how we would be reporting our restatement earnings for the same year in a different year. Let's say standing at 2024. Now we are standing at 2024 where in let's say it's quarter three where we will be reporting the restated earnings for 2023. So this is how the reporting frameworks actually works. I am not finding any like practical example to give you. So this is the best way like I can give you like they disclose in the footnotes like how there was a change in their disclosure perspective. And yes, the analytical implication says that the prior period adjustments usually involve error or new accounting standards. I told you in India, let's say NFRA, with the coming of NFRA, some accounting standards of ICA got challenged, and even Indian accounting standard replace the old accounting standards that were prevalent in India, let's say before 2016. The year was 2016, then when we started the AS in India. So, and they typically do not affect the cash flows because cash flows might be not be affected because it's an accounting error that you are correcting, not a cash flow error that you are correcting. So it doesn't make sense that our cash flows might be affected, and the analyst should review adjustments carefully because errors may indicate weakness in the firm's internal controls. And in USA, it is actually studied as a part of SOX. So SOX stands for Sarbanes-Oxley Act, and it is usually a case study. It's actually an act in USA. First of all, it's a Sarbanes-Oxley Act in US, but it is always studied as a part of case study in doing the internal controls analysis checklist for any firm to take place.